Ladies and gentlemen, good day and welcome to the earnings conference call of Alicon Castalloy Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Mayank Vaswani from CDR India. Thank you, and over to you, Mr. Vaswani.
Thank you, Tanvi. Good day, everyone, and thank you for joining us on Alicon Castalloy Limited's Q3 and 9 months of FY23 earnings conference call. We have with us on the call today Mr. Vimal Gupta, Group CFO, Mr. Veera Babu, Group COO, Mr. Shyam Agarwal, Chief Marketing Officer at Alicon Castalloy, Mr. Andreas Heim, Managing Director of Alicon Castalloy, and Mr. Rajiv Gupta, Head of Domestic Business of Alicon Castalloy Limited. Mr. Vimal Gupta will cover the financial performance for the quarter, following which Mr. Agarwal will walk us through the operating highlights. In order to share the developments in both the global and domestic markets, Mr. Andreas Heim and Mr. Rajiv Gupta will provide insights on these areas. Following the comments from the team, our Group COO, Babu, will give us a brief summary of the quarter gone by and encapsulate the strategic imperatives. Thereafter, we shall open the forum for a Q&A session. Before we begin, I would like to point out that some of the statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings documents that have been shared with all of you earlier. I would now like to hand over the call to Mr. Vimal Gupta for his opening remarks. Over to you, sir.
Good afternoon, all our investors. Thank you for taking the time out to join our earning call. I trust that all of you have had a chance to review our earning documents, which were shared last Friday. We are delighted to share a strong set of results for the third quarter of financial year 2022-23. As we have indicated earlier, 2018-19 was the best year in the last few years for the global auto industry. Thereafter, it was besieged by multiple challenges as well as transition to EVs. Our assessment is that the domestic industry has reached a performance level of approximately 83% in the first 9 months of financial year 2023 of the level set in 2018-19. While the international auto industry is at about 87% level in calendar 2022. At Alicon, our revenue performance in the 9 months for the financial year 23 is 124% of the benchmark that we had set in 2018-19, clearly showcasing a different trajectory of performance when compared to global and domestic auto industry. This outperformance can be attributed to our transformation initiatives built up on our 5-pillar strategy. These include a sustained focus on traditional ICE business, addressing the opportunities from carbon neutral technology, including battery electric vehicles, hybrid electrical vehicles, plug-in hybrid vehicles, fuel cell and hydrogen cell technologies. Third is the opportunity from structural parts or technology agnostic parts, which remain consistent no matter which fuel technology is used to power the vehicle. Fourth one is non-auto business encompassing opportunities from sectors such as defense, energy, telecom, to name a few, where our competencies can be leveraged. And the fifth pillar in this strategy is enhanced customer wallet shared through value add and combining products to offer customer one-stop solution. The traction in the current performance can be attributed to the implementation of this growth strategy. We have invested a significant effort in transforming our business model to emerge as a more agile and diversified entity, capitalizing on our core strengths. Our global teams have been engaging customers in deeper conversations to leverage capabilities around design, research and development, and value engineering, while our track record validates the strength of our processes as well as our reliability as a supplier. This is vindicated by the sustained rise in our order backlog and addition of marquee logos to our customer set. In that backdrop, I will run through the financial performance. The highlights of our financial performance for quarter 3 of financial year 23 year on year are revenues at rupees 362 crores. This is higher by 29% year on year basis. The EBITDA at 42.4 crores, that is higher by 25%, and post-tax profit of rupees 15.6 crores, that is also higher by 28%. Our EBITDA margins in quarter 3 financial year 23 stood at 11.7% versus 12.1% in quarter 3 of financial year 22. The highlights of our financial performance for the 9 months ending December 22 against the 9-month period ending December 21 are revenues at 1,084 crore, higher by 43% year on year basis. The EBITDA at rupees 124 crore, higher by 61%, and post-tax profit at 42 crore, that is higher by 280% year on year basis. Our EBITDA margins for the 9 months ending December 22 stood at 11.4% against 10.1% in the 9-month period ending December 21. The quarter 3 revenues are marginally lower than quarter 2 of financial year 23, during which we posted total income of 378 crores. This was mainly due to higher volumes at OEM to cater the festive season demand in domestic volumes in quarter 2. In quarter 3, planned annual shutdown in domestic market and holiday seasons for overseas customers in end December led to the gap. As the transit shipping time have reduced post the effect of pandemic, overseas customers' volumes have also started to reduce the higher inventory level maintained earlier when shipping times were disrupted. During the quarter, we also witnessed some cooling off in input prices, but these remain substantially higher than the corresponding period last year. While most the input prices are passed through for us, there is some time lag in getting the price adjusted for these increases. Some element of pass-through impact from prior quarter combined with the improved product mix have helped us to largely protect our gross margins despite the sharp rise in material prices on year basis. In line with our strategy, the share of business from passenger vehicles, commercial vehicles, export and carbon neutral technologies has grown, enabling a richer product mix. Also, the focus on machined parts has enabled us to realize better margins. The initial benefit from this approach has added to the momentum this quarter. If we look at the split of the fresh order received during the first 9 months of financial year 23 in terms of 5 pillars. So EV represents 56%, IC represents 28%, structural 8% and non-auto 8%. This is with the big order win of JLR EXL in EV segment in quarter 2 of financial year 23. This is in line with our strategy of higher share of business from EV and 4W. From the perspective of market segment in 9 months, the order book is represented by 4W at 89% and non-auto is 8% and 2W is 3%. While our endeavor to improve margins through rebalancing product mix is being proved, we continue to face challenges. While we had shortlisted a 6CM framework with the new challenge of a recessionary environment emerging, we have now categorized the challenges facing us internally as the CM framework. The COVID impact, the chip shortage issues, cost of new product and development, the conflict between Russia and Ukraine, global cost-based inflation, supply chain challenges, as well as the challenge from the recessionary environment. Kaizen principle-based initiatives that we have adopted have helped us bring in optimization across all methods of our business model, right from the inventory management, employee expenses, to power cost optimization, among others. We have seen a notable reduction in fixed expenses as well as streamlining of overheads due to these initiatives. The improvement in EBITDA level are indicative of the element of enhanced value addition and enriched product mix. As we have shared earlier, our 3 to 4 years target is to improve EBITDA margin to a level of 14 to 15% on the back of growth initiatives combined with cost efficiency measures. On the capex front, we have deployed 27 crore rupees during the quarter and have deployed a total of 66 crore rupees during the 9-month period. This is in line with our plan to deploy around 90 crores in financial year 23, which includes maintenance capex and new machining capacities. In quarter 3 of financial year 23, our plants in India and Europe operated at a utilization level of 65 to 70%. To summarize, we are continuing on the positive momentum and are confident of delivering better financial and operational performance during financial year 23. Our focus continues to be on improving margins, return ratios, and streamlining our working capital cycle. We are confident of delivering strong and sustained growth in the quarter ahead. On that note, I would like now to hand over to Mr. Shyam Agarwal, who will talk about operating highlights for the quarter.
Thank you, Mr. Vimal. Greetings to all of you. The domestic auto sector saw improved volumes during the quarter with growth of 5% on YOY basis, and within this passenger vehicles grew 21% on YOY basis. Commercial vehicle grew 12% on YOY basis. The improved growth was driven by the pent-up demand, improved availability of semiconductors, new product development, and in case of commercial vehicles and heavy vehicles, factors such as increased infrastructure spending, mining activities, logistics growth, and resumptions of offices and schools added the demand. Two-wheeler volume received, we are on track to achieve 20 to 22% from carbon neutral technologies by financial year 2025-26. There are certain ongoing discussions with global customers which hold potential to drive these targets higher. To achieve the share of carbon neutral revenues, our teams are working on executing the orders from Tata Motors and Dana in the domestic businesses. We also have continued traction in our projects with JLR, Danfoss, Scania, Rimac and Bosch in the international business. On that note, I would like now to hand it over to Mr. Andreas Heim to throw light on the global business.
Andreas?
I'm audible?
Yes, sir, you're audible.
Yeah. Thank you, Sean. A warm welcome to all of you. I will briefly cover the developments on our international business. We witnessed a soft performance during the quarter due to the prevailing macroeconomic situation due to the
operator here. We'll just reconnect you. Your voice is not clearly audible. Just give me a moment, please.
Okay.
We have this reconnected, so you may go ahead, please.
Thank you, Sean. A warm welcome to all of you. I will briefly cover the developments on our international business. We witnessed a soft performance during the quarter due to the prevailing macroeconomic situation due to the Ukraine war. This led to distribution in the supply chain for manufacturers based in Europe. With gas reserves being carefully monitored as well as higher energy costs, our customers have found it challenging to operate plants at high utilization levels. Further, with the sharp rise in inflation and pressure on household expenditure, there has been reduced volumes in the European market. Added to that has been the holiday season towards the end of the year. Despite this, the global business contributed to 21% and 22% of the total revenue during the quarter and 9 months in the financial year, respectively. However, we believe that the customers are now poised for an improved performance after absorbing the multiple challenges of the prior year. Input prices have stabilized after peaking out. In recent weeks, we have seen prices of gas also ease out into slightly lower levels, leading to lower energy costs. The supply chain pressure and logistical challenges are easing, and constraints from chip availability have also moderated. Our customers are beginning to sound more optimistic about their production schedules. In the backdrop of improved chip availability, Jaguar Land Rover has indicated better volumes for the calendar year 2023. Bosch has indicated an improvement in the full year offtake of the back of new additions in their customer set. Further, we have added 1 new part and 1 logo with the addition of Alicon, a premium manufacturer of e-scooters in Europe. With this order win, we have entered into a new segment and new market. We have also spoken of addition of Ducati to our customer roster earlier, and there are indications that the SOP of the parts awarded will commence in September this year. Overall, we have entered 2023 with far more optimism. Customers are showing signs of having adjusted to the challenging circumstances of the previous year and are indicating an improved outlook of the months and the quarters ahead. On this note, I would like now to hand over to Mr. Rajiv Gupta, who will cover the development in the domestic business for the quarter.
Thank you, Andreas. Good day, everyone. The Indian automotive sector had a moderate growth of 5% year-on-year basis, impacted by the flattish growth in the two-wheeler segment, which was impacted by the OBD regulations. Fortunately, there was better traction in passenger vehicles and commercial vehicles due to increasing level of economic activity and higher level of infra spend. The contribution from our domestic business stood at 79% during the quarter. The momentum of two-wheeler dipped this quarter as the OEMs offtake has moderated due to the introduction of onboard diagnostics regulation by the government. The OBD systems provide self-diagnostic functionality incorporated into the engine control system, which can alert the vehicle system about potential problems that can impact the vehicle. These contribute to better emission management and also prevent potential long-term complications. With this, various OEMs were affected, especially two-wheelers, and we noticed a decline in schedules towards the year-end to reduce inventories as the models without OBD will not be permitted to be sold post-April 1st, 2023. We are seeing good inquiries in the market for new technology applications and are optimistic that strengthening macroeconomic conditions will help us sustain this momentum. More importantly, domestic customers are evaluating suppliers based on capacities and track record in the EV offering. Alicon is well placed in this regard with rich experience in this space and compatible track record of 94 parts with 17 customers till now. Our European subsidiary Alicon, which has been supplying EV components since 2017, has been a key contributor to our growth competencies in this space. In the non-auto business, our order for a prestigious telecom project under Atmanirbhar Bharat is progressing well. In the non-auto business, there is further traction as we are in discussion with the Department of Defense for supply of further products catering to defense requirements. On this note, I would like now to request Group CEO Mr. Veera Babu to share with you his perspective on the Alicon performance.
Thank you, Raju. Good day, everyone. We have reported strong results during 9 months of the current financial year. We have marked an uptick in client engagements and have demonstrated strong progress against new orders. The order intake momentum has substantially improved in recent years. By leveraging on research and development, design excellence, and value engineering, we have demonstrated to customers of our deep value that we can provide them as a supplier of repute. The onus is to now ensure robust execution of these orders to provide customer products that are delivered on time, aligned to their schedules, and at the quality standards and technical specification that they have specified. An important element that we are focused on is a deeper footprint on technology. We have tried to automate certain processes of our operations. Further, we are ensuring optimum utilization of our resources by focusing on driving efficiencies, by addressing costs across our business model and enhancing yields. We further elevate our competitiveness. We are actively working towards increasing our substantially footprint and ensuring commissioning of our captive solar plant, which will meaningfully transform our energy mix. On this note, I would now request to moderate to open the forum for any questions or suggestions that you may have. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may enter star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Yash Dalal from Sushil Finance. Please go ahead.
Hi, good afternoon, everyone. Am I audible?
Yes, you are audible.
Yeah, so my question is, as we can see, your revenues are up, but your interest costs have remained the same. So we want to understand your capital efficiency or working capital. Has it improved? Could you throw some light on this?
Yes, there is definitely we are focused on the improvement of the capital efficiencies, because you compare it for the 9 months, it is almost equal to the last year 9 months cost. So maybe some impact of the QIP, but we have the impact of the higher interest rates in this year. But definitely we are focused on the investment side as well as on the how to improve our balance sheet, and especially on the negotiation of the interest rates with our bankers as well as to control the debts.
Okay, thank you. And just another question is, your depreciation is high, as we can see, so your profits are seen low, but your cash profits are increasing. Do you think this trend will continue going forward?
Yes, definitely we are more focused on to improve. One is that profitability as well as mainly that the how to improve further this cash profits, because cash is the reality. So definitely in the speech we are explaining how we are improving, how we are setting our goals, the targets in the coming years. So along with the numbers of the revenues, the profitability, the main focus is how to improve our cash flows.
Okay, and thank you. And another question was, could you give us some revenue guidance going forward for the next year?
For the next year, one more point I just missed to address, that based on like you have raised the issue of the question on the cash flows. So we have the rating agency CRISIL. So they have also improved our rating from A stable to A positive. So they have also identified and okay, there is an improvement in the cash flow management in Alicon. So coming to this, the revenue, so it is a forward-looking statement, but definitely like we are explaining for the next year, we are expecting at this moment of 15% growth against the current year of 22-23. So let's see that how we will close, because the base is also increasing, continuous improvement in the quarterly performance of the current year. And at this moment in the 9 months, there is an increase in the 43% in the revenues. So definitely we are putting up a higher base for the next year. So we will have a more clear picture in the next call, but at this moment we are estimating that approximately 15% we should achieve our growth in the revenues in the next year.
Right. So, but if we go by a 15%, so I would assume around 1650 would be your estimation for next year in revenue.
That you can work out, because we cannot give the numbers. So definitely, but this is based on this the new orders we are improving. Continuous new order booking is there, and now like from the last 2 years we are giving the new order books. So those are converted into the real numbers, and we are further more focused on resourcing business, especially like where the ready business is available, because the new orders generally we go, then there is a development lead time of 1.5 to 2 years. So to improve our numbers in the next year, so one focus area is resourcing business. So ready business is available, so how to shift to Alicon.
Okay, correct. So that's good to hear, because it's just going by the numbers. If in this 9 months of this year, FY23, your EBITDA has been at 124 crores. So just maintaining the same margin, if we do at around 12%, then we would say our EBITDA would increase quite a bit, maybe by 3% next year. Is that correct?
I think you are forcing me to give some forward-looking statement. So, one is the revenue growth, another we are focused on to improve our margins. So our target for the next year is at least to improve 100 basis points in our margin. So on that basis you can work out. So maybe that you are good in the numbers.
Okay, thank you. Just sorry, one more last question. Was you spoke about your onboard diagnostics, the norms that are scheduled to take effect soon. So what are the new opportunities or challenges that will throw? How will it affect and impact in the coming quarters next year onwards?
So I think I asked Rajiv to explain this.
So we are noticing volume reduction, especially two-wheelers, the two-wheeler OEM on the account of OBD, which was clearly explained in our speech also. There is marginal or no change in our path with this drive by the government, as it's especially for the exhaust system. But we noticed the volume drop that is late Q3 and also in Q4 is expected, as OEMs need to curb the production numbers. As post 1st April 23, they won't be able to sell the existing vehicles. So one is, yes, there will be an effect in Q4 with this area. But if you talk about opportunity, there is opportunity, especially in the Q1 in next financial year, because we see, because these OEMs will try to start building the stocks, which they have planned to deplete in Q4. So we are working closely with OEMs how to further build those inventories at their end. So that is what we could work out at this moment.
Okay. Thank you so much for your answers. I'll jump back in the queue if any further questions.
Thank you.
Thank you. Ladies and gentlemen, if you wish to ask any questions, please enter star and 1. The next question is from the line of Raghunandan NL from M Global. Please go ahead.
Thank you, sir, for the opportunity. Congratulations on a strong set of numbers. Welcoming Mr. Agarwal and Mr. Veerababu for sharing thoughts with the investor community. Sir, my first question was on the order book. Can you indicate what is the size of the order book to be executed by FY26? Last quarter, you had indicated around 3,400 crores.
So, Raghu, I think little bit one more explanation we would like to give, because all these order books what we are discussing and explaining, those are as on the date of, that is means 25-26. So this is almost around 3 years. So whatever the new orders are coming, those real volumes we will be able to see post 26. So I think now maybe some new numbers will start giving from this call, but definitely we will link with the earlier numbers also, so it will not be some confusion for you to understand. So when we talk about till 26, so we are at approximately 3,500 crores of the order book, and yearly average is coming around 750 crores, and in 20 to 23 we are expecting the execution of 500 to 530 crores in that range, and further jump, because now these orders were booked a year back or 2 years back, and in next year our estimation is for the execution of around 700 to 750 in that range. So that is based on the old numbers, but definitely we would like to now give it some increase in the number of years, because now we are talking about 25, 26, the last 2 years. So we have converted our numbers, our order books till we have 28, 29. So that is give a clear picture of the next 6 years. So if we go for that, so our order book stands at around 7,000 to 7,500 crores in that range. So 7,400 we can take a number on this, and yearly average sales is coming around 1,050 crores over the next 5 to 6 years. That is the incremental sale we are talking about, and if you can add our regular sales, that is in the range of 12 to 1,300 crore, because this number what we are talking about 7,400 crore, that is base year is 22-23. So we are not including the orders already executed in the previous years. So I hope Raghu, you are able to understand what we are explaining.
Yes, sir. Yes, sir. This was very helpful actually, and strong for share. Thanks so much for sharing the strong pipeline. Sir, just one clarification. I missed the part when it was initially explained the carbon neutral or the EV share in sales and order book. I think the earlier target was 36% by FY26. Did I hear correctly that in the opening remarks it was mentioned 20 to 22%?
Yes. Basically, if you see in this portfolio, we are having a close watch. We are having a close watch with our customers. Also, what we can see, there are a lot of alternate fuels also coming apart from the pure EV when we talk about, like the hybrid solutions, which recently Toyota has come up with a model of hybrider and even high cross. And also actively OEMs like Daimler, Ashok Leyland recently with Reliance is coming up with hydrogen cells. So what we could understand very clearly, and also like Maruti is aggressively working on the CNG hybrid. So what we can sense that this particular share will be supported by these alternate fuels also. So talking about our projections for 25-26 years, we were a bit confident of touching 36% share by 26. And if you see with the current order booking and the orders in hand, we've already touched somewhere around 20 to 22% for the year 26. With strong discussions with our customers going forward in next 18 to 20 months, we are a bit confident of touching this number.
Thank you, sir. That was very helpful. On the subsidiary side, the performance seems to be under pressure. Looks like a revenue growth of 9% and EBITDA margin at 8.1%. I'm taking subsidiary performance by deducting Concall minus standalone. How do you see the performance ahead, especially should margin improve with the reduction in the gas prices?
Yes, Raghu. So in this, definitely there was a pressure on the subsidiary numbers. In the current year, you know that the reasons being the increase in the input cost, especially on the energy side, and definitely they have also impacted the material cost. So, but what we have seen just now in the quarter four, there is a good demand is coming up for the high margin parts, and in the next year we are hoping that we will be able to deliver good numbers because the order book is increasing, and on the other side there are two actions we have taken. One action is being that renegotiate the prices with the customers, especially on the energy and the increase in the input cost, that we will see the result. And the other side, the cost has started down, so that what we were expecting, so that is not going to happen. And the third point is that the government, especially the Slovakian government, is supporting to subsidize the energy cost. So all these actions are going to support in the numbers of the next year.
Got it, sir. On the captive solar plant, would that lead to power cost savings? What kind of savings are expected on an annual basis once it is commissioned?
So in the next month, we are hoping that we will start. and expected yearly saving of 5 to 6 crores.
Got it, sir. And just a last question on the overseas business. What is the kind of growth expectations would you have for next year? I'm just trying to understand, would you continue to see the share of overseas business going up?
So, yeah.
Yeah, definitely. As you mentioned, we notice very clearly the global numbers would definitely hit in the next year. If you see the market numbers, this year the global numbers have hit an increase of 6%. If we see region-wise, except Europe, all the segments have noticed good numbers. Especially if we talk about US, it was a double-digit number. We have noticed the impact in Europe because of the energy cost and other Ukraine war. The supply chain was disrupted. But next year it's promising. The total industry is expected to grow somewhere around 5 to 6%. And the good thing is, Europe, we are anticipating an increase of roughly around 6 to 8%. With this and with the penetration more towards the global orders, we are quite confident to increase in the next year with the global share over the total sales.
Got it, sir. Thank you. Thank you so much. I'll come back in the queue.
Thank you. Ladies and gentlemen, if you have any questions, please enter star and 1. Participants, to ask a question, please enter star and 1. We have a follow-up question from the line of Raghunandan Anil from MK Global. Please go ahead.
Thank you so much, sir, for the opportunity again. Couple of questions. Firstly, on the working capital side, now that supply chain situation is improving, would that help in reducing our working capital requirements? That was one. And secondly, the company had an aspiration to turn net cash. How are you seeing progress towards that target? Thank you, sir.
So, Raghu, one is like the improvement. Definitely now we have seen that little improvement, like in the first question we have also explained how we are focused on this, and hopefully you will see the numbers in March, the impact of the improvements in the working capital management. And now we have explained in our speech about the reduction in the transit period for Europe and the US, that has actually gone down from 100 to 125 days to 70 days, in that range. So that is also going to impact on the working capital management, and we will be able to improve that. And further negotiations are also going on with some customers to improve. So definitely we are focused on this, and especially on the cash flow management. Like for on the plus side of the cash, so maybe we'll see in the next year.
Thank you, sir. Thank you very much.
Thank you. Participants, if you wish to ask any questions, please enter star and 1. The next question is from the line of Apurva Mehta from EM Investments. Please go ahead.
Hi, sir. Just wanted to know your execution of new orders, which you are talking about 750 crores for 23-24. So is it right that the estimate is around 750 crores?
Your voice is not very clear. Apurva, can you please repeat your question?
Apurva, your voice is coming muffled, so if you're using headphones, please use the handset mode.
Yeah, just hold on. Hello, is it clear now?
Yes, now it's
Yeah,
clear.
yeah. So the new order execution of 750 crores for 23-24, is it true that we will be executing around new orders of 700 or 750 crores in 2024?
Yes, in 23-24, approximately 750 crores we are expecting to execute.
And your steady state turnover will be around 1,200 crores. That is true, that will continue?
That is, that's if we, same thing I was explaining, that this includes, because already execution is there from the last 2 years, so there will be additional approximately what we say 250 crores from the new business in the next year.
Because this order booking, what we are talking is roughly around 327 parts. And this we are tracking since 2018-19.
Yeah.
Already few parts came into regular production. But with these set of parts, definitely we are confident to make around 750 crores of sale for the next year.
So, and the current year is approximately, I told you that 530 crores. So whatever the difference is there, so that will be further addition to the numbers of, we can say, base year of 22-23.
Okay. And this new order of 750 will have definitely better margins, where you had lower margins, overall the margins will expand?
Yes, definitely. If you see the total contribution of what we are talking about new business, around 79% is my four-wheeler components.
Okay.
And which we have noticed very clearly, we get good margins because we have good scope of giving them a value-add part. And if we see in terms of exports, near about 47% is the export parts what we are talking in this part.
Okay. And because of this currency movement which has happened on the positive side for us, that will also add up to our profitability?
Up to certain extent, not so much, because generally when we negotiate the business for the exports, we also hedge the currency with the customers.
Okay. And any new order pipeline which you would like to highlight that we are negotiating or we are having some good visibility for that on the non-auto and the auto part, both?
Yes, at this moment, if you see, massive developments are in discussion because this is a junction where the OEMs or a Tier 1 is working on new platforms like from IC to EV or some initiative of lightweighting of parts. So this is a great opportunity for us even to grab this opportunity and give them an early solution. And that's the reason we are actively working on this area with participation of more in conferences or exhibitions, visiting our customers on frequent basis along with our global visits. So we are under strong discussion because if you talk about EV, this is actually a race where a OEM knows very clearly if they are able to get a product in a quick period of time, they have an opportunity to grab more share. And in that junction, even the OEMs are looking for a supplier who have got rich experience on this domain. And this is a good opportunity for us where we have already are in this platform, be a two-wheeler scooter, be a motorbike, be a passenger or a commercial. So this is giving us an edge over our competitors. So going forward, yes, strong discussions we are in discussion with our existing and upcoming customers, which definitely in the coming quarters, 1 or 2, you will see a good momentum on that ground also.
And our aspiration to have 15% plus margin on overall basis, is it possible to get on next year or maybe post next year? Or, by the fag end of the next year, is it possible to us to achieve that number?
So immediately, Apurva, is not possible. Like in previous question, I have explained because it will happen phase-wise, step by step.
Okay.
Immediately, a big jump we can't see because we have a strong already existing base of business. So in this first year, like in 23-24, our target is to improve by 100 BPS. So we see that, and as already we have explained in our commentary that in next 3 to 4 years, our target is 14 to 15%.
Okay. Thanks a lot, and I wish you all the best.
Thank you.
Thank you. As there are no further questions, I would now like to hand the conference over to the management for closing comments.
Thank you. I hope we have been able to answer all your questions satisfactorily. Should you need any further clarifications or would like to know more about the company, please feel free to contact our team or CDR India. Thank you once again for taking the time to join us on this call, and we look forward to interacting next quarter.
Thank you very much. On behalf of Alicon Castalloy Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.